Hi everybody, this is AJ speaking. In this video, we'll be discussing the Xiaomi investment case at the current share price of $52. And this is Hong Kong dollars, this is an important point. The relevant ticker is 1810.HK for Hong Kong listing, which you see up here. The chart you're looking at right now is for the last 6 months, and you can see wasn't very exciting. Stock is up 1.6%. To get a better picture of what is going on, we need to zoom out a bit. This is what you see on this chart, and you can see when we go to the year to date, stock is up 52%. But it doesn't stop there, we need to zoom out a little bit more. This is what this chart does. You can see stock is up 175% in just the last 12 months. So this obviously would have been a phenomenal investment, but that's not the end of the story. We need to zoom out even further. So this chart shows you over the last 5 years, and the stock has done 189%. Even though this looks quite impressive, we need to turn it into an annual number to get a better sense of this performance. And when you do this, you realize that, in quotation marks, only compounds at 24% annually. This is still a very strong performance, but you have to keep in mind, and this is also evidenced by looking at this share price chart, that you have to look at it in risk-adjusted terms, and the fact that this stock rallied to over $30, then returned to below $10, and then stayed there around $10-15 for quite some time, and then after only a long time then started to really kick off, shows you that this was a very high risk investment. And once you consider that, you realize that the 24% annually compounding is not that impressive, because you did take a lot of risk if you invested in that stock. But this is now ancient history, so let's look what's going on with the stock. And for that, we start by looking at the most recently reported quarterly performance. That was just a couple of days ago. Xiaomi reported the second quarter. So in this first chart or slide, you can see Xiaomi's total revenue performance. Revenue came in at $16.1 billion, and this is US dollar, not Hong Kong dollar. And just throughout this presentation, when I show you share prices, this will always be in Hong Kong dollar. And when I show you financial metrics, they will all be in US dollar. So this 16.1 billion is, first of all, an all-time high, and secondly, that implies a year-on-year growth rate of 31%, so very strong growth, and also in part explains why the stock rallied so aggressively up until recently. Because you can see in the fourth quarter, 2024, revenue grew by 49% year over year, and then in the first quarter, 47% year over year, so very high growth rates. So what was driving that? And to understand it, we need to understand, first of all, how Xiaomi makes money. And for that, it's always good to start with the segment disclosure. And Xiaomi splits its business high level into two big buckets. But then one of these buckets can be subdivided further. So the two main buckets, and I put this here in the notes, is the smartphone and AIoT bucket. I get to these abbreviations in a second. And the second big bucket is the smart EV, AI, and other new initiatives segment. And the first bucket, smartphone X AIoT bucket, we can break into smartphones, IoT and lifestyle products, internet services, and other related businesses. So AIoT stands for artificial intelligence of things, and IoT stands for Internet of Things. And just to make it very simple, so the smartphone segment is obviously Xiaomi's large smartphones business. Xiaomi is one of the top smartphone sellers globally. But Xiaomi's smartphone business is very different from, for example, Apple's, and we'll get to this in a moment. The IoT and lifestyle products is basically Xiaomi's large consumer electronics / household goods segment. Xiaomi offers everything from water cookers, hair dryers, air conditioning units. I mean, basically all kinds of devices, gadgets you find in a modern household. And that segment performs quite well, as we will get to later. Then the internet services segment provides all kinds of software products on a subscription basis. This is a very high margin segment, typically for a software type business. And other related businesses comprise a lot of other things I will not dive into. So basically, the key takeaway from this is already that Xiaomi is engaged in a lot of different businesses, but it's all quite tech heavy. And this has always been a Xiaomi thing from the beginning. They want to offer the consumer pretty cutting edge technology at an affordable price. And then the latest significant extension of Xiaomi's business, let's call it empire, is the addition of the EV business. And here in this segment breakdown in purple color, you can see this has performed quite well. The business started selling EVs only from the second quarter of last year and has already grown to 3 billion in quarterly revenue in the second quarter of 2025. And this is also a big reason why the stock took off so phenomenally over the last 12 months, because Xiaomi basically pulled off what a lot of people thought Apple would when Apple was rumored and later turned out it was true that Apple was working on an electric vehicle, but later abandoned that project. Xiaomi, a company that is in many ways similar to Apple, did actually pull off quite successful entry in the electric vehicle space, as we will see in a moment. So before we move on, let's just have a quick look at these numbers. So you can see in terms of revenue, the still by far biggest segment or meaningfully largest segment, and the second largest is the smartphones segment. But you can also see clearly that while it was clearly by far the largest segment, for example, if you look at 1Q 2022 of 11.6 billion in total revenue, the smartphone business brought in 7.2 billion. But what you all can also see that the smartphone business declined for a couple of quarters, then recovered revenue growth and has now yet again entered, at least for the last 2 quarters, a shrinking phase. So that obviously is not great, but we'll get to why that's actually not a major problem in a moment. But then when you look at the let's call it the appliances segment or gadgets, Xiaomi does quite well in that area, and in the second quarter brought in 5.4 billion in that segment, all-time high, significant both year-on-year growth and sequential growth. The internet services segment also experienced some, I would say, acceptable growth over the last year. Not a huge growth rocket, but still meaningful. And then, of course, in terms of revenue, the biggest driver, electric vehicles. So let's look what actually happened in the electric vehicle space in terms of Xiaomi's business success. So this shows you how many vehicles Xiaomi sold on a quarterly basis since start. So start was in second quarter of last year, as I said. In that first quarter, Xiaomi sold 27,000 vehicles, which was already quite impressive. But it didn't stop there. Xiaomi expanded its quite significant early success quarter over quarter. And even during the typically weak first quarter of 2025, managed to grow vehicle sales sequentially, that you can see up here at 8.9%. This was also part of the reason why the stock rallied so much. And then in the second quarter, added another 7.2% for 81,300 vehicles. This, by global automotive standards and Chinese automotive standards, is extremely successful, especially given the enormous competitiveness of the Chinese vehicle market. And as of the time of this report, this is right now it's August 2025, Xiaomi already sold over 300,000 vehicles. So bottom line is, the EV launch was extremely successful, but it doesn't stop there, because vehicle sales volume, as I discussed many times before, is not a great metric, because you always need to look at how much revenue is generated, because it makes a huge difference whether you sell, let's say, a $40,000 vehicle or a $10,000 vehicle. It also important to look at how Xiaomi compares to other competitors. So how Xiaomi compares is what you see on this chart. And you can see that Xiaomi already, and I think you have to call it leapfrogged, Zeekr. Zeekr is a premium brand owned by Geely, a brand for very high performance electric vehicles. NIO also leapfrogged what I would call NIO Group. NIO Group comprises 3 brands, which is the NIO brand, the Onvo brand, and the Firefly brand. So Xiaomi outsold all these brands combined with just one vehicle. This just shows you the enormous success, and this puts Xiaomi into, or at I could say, a spitting distance to Aito. Aito is also relatively, or in recent months, quite successful brand owned by Huawei and Ceres Group, and the distance to players like XPeng and Leapmotor is also not that great. Then, of course, we have the volume king in China, that is BYD. But BYD is a very different type of company compared to Xiaomi. And then, of course, we need to mention Tesla. Tesla is number 2 in China. And third currently is Li Auto. And I'd like to point out this is the NEV ranking, or NEV, which is New Energy Vehicle segment. But Xiaomi, just like Tesla, does only sell into the fully electric, so the BEV or battery electric vehicle segment of that overall segment of the market. But to understand the true strengths of Xiaomi's entry into the Chinese market, you really need to look at the performance by model. And this is what this analysis does. So this analysis looks at the highest revenue generating fully electric vehicles in China. And my followers will know that the number 1 in China is Tesla Model Y. And over the last 3 months, I estimate Tesla generated almost 4 billion in revenue just with the Model Y. And then, surprise, surprise, Xiaomi, with its until recently only model, the SU7, which is a vehicle comparable to the Model 3 in terms of form factor, dimensions, etc., comes in number 2 and generated almost 2.6 billion. And thus significantly more than even the Tesla Model 3. The way Xiaomi did this was with a very compelling price point. It's cheaper than the Model 3. Number 2, very compelling software. Xiaomi's vehicle software offers features Tesla doesn't. For example, phone mirroring. In addition to the specs also exceeding the specs of Tesla Model 3 in terms of range and certain performance metrics. However, the Model 3 is still more efficient. But that apparently is not a winning or a key factor for a number of consumers anymore, provided range is there and charging speed is there. But then when we continue looking at this ranking, after these, let's call it top dogs, which is Model Y, SU7 and the Model 3, you might think Geely Star Wish was also like a quite compelling vehicle or a competitor. Unfortunately, that would be, I think, wrong, because the Star Wish is a very cheap vehicle, and these 3 vehicles, so the top 3, they are broadly in a similar price bracket, so they are therefore quite comparable. But the Star Wish is an ultra cheap vehicle that costs significantly less than half than what these other top 3 vehicles cost. So the Star Wish generates its still quite meaningful revenue on very large volume. Then when we look at number 5, BYD Seagull, it's somewhat similar. The Seagull is also compared to the top 3 vehicles, a quite inexpensive vehicle selling for less than half of what these other vehicles sell. The XPeng Mona M03 is comparable to the Xiaomi SU7 but is cheaper. And then number 7, 8, 9 all belongs to BYD. These are also less expensive vehicles, and their revenue ranking is the result of also relatively high volume. So the bottom line is Xiaomi does not only compare well against the top dog Tesla in China in terms of producing killer products, but the key insight here is if you remove Tesla from the Chinese market, Xiaomi would be a huge leader in terms of model performance. Nobody, again, if you remove Tesla, was able to produce a vehicle that was as successful as Xiaomi's product. And this now explains further why the stock rallied so much, because I think a lot of people had vowed, and justifiably so, that Xiaomi would actually generate this much success. A lot of people thought, oh, this would be dilutive to Xiaomi, meaning Xiaomi would, yes, produce a lot of revenue because cars sell at a very high price. And even if you don't sell this many units, you still can generate a couple of billion in revenue, but the margin would be very low, because a lot of the other current EV sellers, like NIO, like XPeng, still have, or until recently had, like in the case of XPeng, relatively low margins. So that's why a lot of people expected the same for Xiaomi to happen, but Xiaomi definitely proved them wrong. But let's move on to not get too stuck on this point. Let's look at overall picture in terms of gross profit. And you can see here also gross profit grew quite materially, 43% year over year to 3.6 billion, new all-time high. Next, we look at what segment was driving this increase in gross profit. And here, right off the bat, we can see these these purple buckets, which is the EV segment. They made a huge impact. So in the second quarter of this year, Xiaomi already generated 0.8 billion in gross profit in the EV segment, which is actually more than what they made in the smartphone segment, which is quite a remarkable achievement, and also shows you that the pains in Xiaomi's smartphone business. Most important segment in terms of gross profit for Xiaomi is the segment for home appliances and gadgets at 1.2 billion in gross profit, and then at 950 million the internet services business, so this software type business. So this chart already explains a lot why the stock rated so much, because again, this gross margin performance nobody had on the radar. Most EV makers, it took years before they even got to gross profitability. For example, Rivian in the United States is still not a gross profitable. The 2 quarters they delivered gross profitability were all driven by one-off items, which were mostly credit sales. And I'd like to add, arguably, compared to, for example, Rivian, Xiaomi operates in a much more competitive market than Rivian. Because right now, and I think no industry observer would argue that point, that China is definitely the most cutthroat market right now. People always talk about Chinese automakers versus foreign automakers. No, I think this has long moved on. It's really Chinese against Chinese. I think if you ask any of the large Chinese automakers, who do you think is your biggest competitor in your home market, they would give you some other Chinese name, and certainly not some European or North American name. With the obvious exception, Tesla. Given Tesla sells the category killer, the Model Y, everyone in China will obviously be looking to that competitor. And this is why we also see in China so many vehicles that look like perfect clones of the Model Y. Up until recently, I should add, because I think we have reached a stage where Chinese automakers moved on from just cloning the Model Y to making products, at least they think, which are superior. And this is what we can see in latest iterations of interior vehicle designs, for example, where they moved beyond the blueprint Tesla provided with the Model 3, and later continued with the Model Y, which is a large screen in landscape and very few buttons in the rest of the cabin. Next, we look at a gross margin. So gross margin is gross profit divided by total revenue. It tells you how much money is left after you paid for delivering the products or goods to cover overheads, etc. In Xiaomi's case, in the second quarter, this was 22.5%. And that was actually part of the reason why the stock did not perform well upon release of numbers recently. This was also a point management spent time on discussing on the earnings call. And they were quick to promise analysts that especially in the smartphone segment, which is still important for Xiaomi, they expect that margins would increase in the fourth quarter, and also that other segments would see gross margin strengthening in the second half of this year. So it will be interesting to see later how management actually performed, but it's for a future video. So the bottom line is gross margin was good, but it did disappoint after this massive rally in the stock. Next, we look why it disappointed, or what was driving it. So these lines show you for all the four main segments the gross margin development in percent, and you can see that that each line from Q1 to Q2 went actually down a bit, with the exception of the EV segment, and overall led to a slight sequential decrease, and that was part of the disappointment. Also, what I would like to point out, the gross margin in the EV segment of 26.4% is exceptionally high by not only Chinese standards, but also by global automotive standards. At present, there is no automaker that comes even close to that gross margin internationally, with one exception, and that is Ferrari, but Ferrari is not an automaker. Ferrari is a luxury goods maker, which is completely different from an automaker that provides transportation. So a lot of people always ask me, okay, how Xiaomi actually does it? How are they able to produce these gross margins? Because frankly, even the very first gross margin they ever reported in the second quarter of last year, when they just kicked off, was already very strong. And a lot of people were doubtful about perhaps there's something with their reporting. I was skeptical when I first saw that, primarily because the volume in that quarter was still low, and therefore the depreciation charge allocation was quite high on a unit basis. The issue is that there's not a ton of detail in the disclosure Xiaomi provides. So therefore, I have to unfortunately speculate, and I cannot directly derive it from numbers. But my best theory right now on how they managed to achieve this quite amazing gross margin is the following. So first of all, even in the first quarter of sales in the second quarter of 2024, Xiaomi delivered 27,000 vehicles. That doesn't sound like much, but keep in mind this was only one vehicle, and also one model. And in that quarter, also the availability of different models was more limited. Only subsequently, Xiaomi expanded the SU7 variants. So what they could do was they focused on effectively making one car, and 27,000, if you think about it in an annualized way, is still over 100,000 vehicles. This is still by automotive standards, not a terrible sales rate. The second aspect is that Xiaomi is a very large company. Xiaomi, as we discussed earlier, dabbles in all kinds of different types of businesses, and they make a lot of stuff. They're not just trading stuff; they're making a lot of stuff. So they're a huge raw material buyer. They're a huge components buyer, chips and other key components. And of course, they will have a centralized purchasing department, just like every other large company, to use their combined purchasing power to get the best deals from suppliers. So if Xiaomi shows up at, for example, a large chip supplier to automotive, for example, Infineon or some others, they will not show up as the startup little EV segment from Xiaomi. No, they will show up as the big group Xiaomi, buying additional chips, and in many cases, just more chips they already buy for dishwashers, microwaves, and appliances, because quite frankly, there are tons of chips that you can use for all kinds of products, and for these products, a lot of these components can also be used one for one in automotive, or with very small modification. So the bottom line is, I think Xiaomi used its massive size to get very good pricing from suppliers, and frankly, pricing that is likely even better than what some of these more established EV players can get from suppliers. Like, I don't think NIO has anywhere the pricing power, or the purchasing power, I should say, of a Xiaomi. XPeng probably doesn't. So I think it's a combination of these factors, plus the fact that Xiaomi specifically designed a factory for making the SU7, just as they have designed a factory just making the U7. So they are using latest state-of-the-art technology for vehicle manufacturing. And I think these three drivers, a single model focus, huge purchasing power, and latest, most efficient manufacturing technologies, these three factors drove this quite impressive gross margin. You might be thinking right now, but AJ, is it really that expressive 26%? Well, to answer the question, let's look at some global automotive peers. That's what this chart shows you. And you can see that right now nobody that is even close. There are a couple of shortcomings in this analysis I'd like to point out. So first of all, the gross margin that you see in this chart is not the pure auto business of all these automakers. And there are good reasons, and I'll get to those in a second. So this is the total company gross margin that you see reported. And depending on which automakers you're talking about, this includes more or less non-auto business. For example, in General Motors' case, they have a very large financial services segment. Even more so BMW. BMW has a smallish motorcycle business, but a massive financial services business. VW has a sizable a commercial business, but also financial services business. Honda is quite meaningfully sized in motorcycles or motorbikes, scooters, that sort of stuff, and makes all kinds of small engines. Tesla, obviously, significantly driven by auto, but obviously large energy business. XPeng, technically also not pure automaker anymore, because they provide, the significant share of the gross margin comes from providing R&D services to VW Group. So then the other problem is, when you compare these companies on a gross margin basis, some of them include R&D expenses in cost of sales. So you have to adjust for that. And this analysis does actually adjust for that. Because if you don't, you completely compare apples to oranges. It becomes kind of pointless. So the reason, big picture, why I show it this way is it strikes a balance between, one, comparing apples to apples in terms of R&D treatment, but ignores the fact that there are non-auto businesses in these other businesses. And the reason is it would be too difficult to make adjustments. I could make them, but then the numbers become unrecognizable to the reported numbers. And then it would be too easy for people to point out, oh, these numbers are off, etc. in comments, and it would be too hard for me to defend myself. So that's why I slightly dumped down this analysis, but the high-level points still stand and would not change even if I made all these adjustments. And these points are, number one, Xiaomi's auto gross margin is exceptionally high by all automotive standards. It's not only high, it exceeds everyone else right now, except, again, Ferrari, but Ferrari is not automaker. And this high margin performance was yet another reason why the stock performed so well. Because frankly, I don't think any analyst, at least as far as I know, had on the radar that Xiaomi would just blow quarter after quarter through gross margin estimates on its auto business. But when you look here on the right-hand side, Xiaomi's income statement, we still haven't really gotten very far, really. And next we get to a very important point, and this is operating profit. So now we jump down here, we skipped operating expenses, and here you see the first issue arising. So you can see Xiaomi brought in $1.87 billion in operating profit. That's quite impressive, 130% year-over-year growth rate. But the problem is it's only a 2% sequential, so quarter-over-quarter growth rate. And that was a big reason why the stock was quite lackluster or negative after earnings. The net result was that operating margin actually decreased sequentially from first quarter 11.8% to 11.6%. It's still up 496 basis points compared to second quarter of last year. And when you look at these margins, they basically reflect the share price, this margin bars, these bars, this shape that you can see. So what is going on? So why, even though the business grew so rapidly, etc., why is operating margin and operating income not really growing? And for that, we need to look at, okay, what lies between gross profit and operating profit, and there's operating expenses. So this is what you see on this chart. You can see operating expenses only grew quarter on quarter 2%, so not too bad, where operating expenses came in at 1.76 billion. And actually, after the first 6 months of this year, operating expenses were down 2.8% to 3.5 billion. So this also looks good. So what's the matter? To find out what's going on, we need to decompose operating expenses in its key components. And this is what this chart shows you. So this chart breaks down operating expenses in R&D expenses, so research and development, selling and marketing expenses, and administrative expenses. But also, Xiaomi operates under operating expenses. Xiaomi reports under operating expenses fair value changes in financial instruments, and then other items. These other items include booked income from investees, so any type of equity investment Xiaomi has in some other company, but a company that is not consolidated, other income, and then also other gains and losses. So now when we look at this chart, so you can see, so that for the second quarter, the key buckets were this blue or dark teal color bar, which is R&D expenses. Xiaomi spent just over 1 billion in R&D in that quarter. The second largest bucket, same size, is selling and marketing expenses. Then we have administrative expenses. This is a gray bucket, not really growing all that much, so not too much to see here, but you can already see that this the R&D expenses and selling expenses, they really have been driving operating expenses. And just so for clarity, the numbers, because there's an expense chart, the numbers that are shown in positive, these are expenses, and the numbers shown in negatives, this is actually income. So the negative shown here, especially this green bar that is in most quarters negative, is actually a positive, lowers reported operating expenses. So is for example, this red colored bar that is also in most quarters negative, i.e. also reduces operating expenses. But here's the problem. Unlike R&D expenses, and unlike selling and marketing expenses, and unlike admin expenses, these other items, these are mostly non-cash in nature. So for example, if you have a fair value change in a financial instrument, you can book a gain or a loss, but it has no cash implications. It's just a write up or write down on something you own, and the ultimate cash impact depends on at what price you ultimately in the future realize that asset. And this can be higher or lower than what you currently record. So it's not a quality item, I would explain it. And that is an issue, because you can see that the favorable OPEX development that we just discussed, and I will just go back to the other chart, is simpler. Here you see total OPEX. So we saw OPEX only grew 2% quarter over quarter, but the reason was that there were these low quality offsetting items, because in fact, as we can see on R&D expense and selling expenses, they did increase quite materially year over year. So for example, last year in the second quarter, Xiaomi spent only 760 million on R&D, and now we are already at over 1 billion. So massive increase in R&D spend. Also same in selling expenses and marketing. Last year, Xiaomi spent 810 million, and now it's also over 1 billion. But because we had these massive fair value changes in financial instrument, we don't see it in the total OPEX number. So this next slide breaks it down so this is, first of all, sorry, this is a very busy slide, but this is not really meant to show a pretty chart, but this is meant to show an analytical chart that helps you truly understand the numbers much better. So first of all, what does this show? So this chart now expresses all operating expenses as a % of total revenue. And you want these numbers to come down. You want to spend less per dollar of revenue and not more. So the black line, the top line, shows you total operating expenses divided by total revenue. And in the second quarter, that came in at a long-term low of 10.9%. So this looks quite good. So you might be thinking, oh, AJ is harping on about OPEX not looking good, but this tells a different story. Wait a second. Let's look at the key drivers. So first one, this teal color again, this is R&D expenses. So 6.7% of revenue was spent on R&D in the second quarter. The same was spent on SG&A, so selling, general, and other administrative expenses. And then actually there's a labeling error that should say SG and not SG&A, but it's a minor point. And then admin expenses, this gray line, 1.4% was spent on that. So these ratios stayed actually quite flat, as you can see in this chart. So Xiaomi spent for several quarters roughly the same amount in terms of relative to revenue on R&D. Selling and general actually came down. Admin also over multiple quarters came down a bit. But in most recent quarters, when you look closely, admin stayed flat. R&D increased a lot from 6 to 6.7%, and selling in general also increased from 6.5 to 6.7%. So despite the massive revenue increase, these expenditures, they actually grew faster. But on the black line, which kept going down, we can't see it because you had these offsetting items which are highlighted here in this bright blue color and this dashed line here in green. These were these non-cash items I explained earlier. For that reason, what we should do, we should strip out these offsetting volatile non-cash items to get a better or more pure view of how Xiaomi's efficiency is developing. And this is what this next slide does. So this slide, also again, I'm sorry, it's quite complicated. This is because it's, an analytical slide. On the left axis, you have the total revenue development here shown in this bright blue color in dollar billion. And on the right-hand side, you have the implied efficiency ratio. Again, the expense item divided by revenue. So now when you look at the black line, you can see that Xiaomi's efficiency actually decreased. The total efficiency ratio, so underlying operating expenses, excluding these low-quality items we discussed, divided by revenue, increased to 14.8% from 13.9%. And that is actually the worst it's been since the fourth quarter. And this came despite, and you can see this on this blue line, revenue really growing very, very quickly. And the problem is, if revenue grows quickly, but you keep spending more and more per dollar of revenue, your growth is actually not worth all that much, because the resulting earnings growth will be significantly less than what the revenue growth suggests. And that's why the market always looks at earnings growth and not revenue growth. And we can see sort of the net result of all of that in Xiaomi's reported shareholders' net income or net income. Net income is the same as shareholders' net income if there is no controlling interest or a negligible amount of non-controlling interest. And that's the case in Xiaomi's case. So when we look at these reported numbers, and please note, Xiaomi reports under IFRS. That's the predominant standard used, especially in Europe. It's overall that there are important differences, but overall it's very similar to US GAAP. So if you're American and listen to this, no, this is not a red flag. A lot of companies use IFRS. So when we look at these numbers, so shareholders' net income was up to 135% year-over-year, so super strong growth to 1.66 billion. Prior quarter earnings were up 160%, and prior to that, fourth quarter was up 91%. This explains why the stock took off like crazy, because you also have to keep in mind the history for quite a long time, for basically let's call it 8 quarters. The company was stuck at producing between 600 or 520 to 750 million in earnings, which probably made a lot of investors doubt the company, doubt the leadership. And then their phenomenal success in EVs, I think then once the money came in, quickly changed the mind of investors, and then the stock just took off. But the issue is that sequentially, earnings growth significantly slowed to just 9%. But because we want to do valuation analysis, we need to look at this on an adjusted basis. I explained in prior videos why you have to always use adjusted basis. I will skip it in this video. So this chart shows you the adjusted shareholders' net income. And just real quick, the key differences between the IFRS reported net income and adjusted shareholders' net income comprise the add back of share-based compensation. You have to do it for a consistent methodology. You have to add back fair value changes. You should also take or unwind amortization of intangibles that emerge from acquisitions. There are a few other items. I put them all here in the notes. On that basis, I think the picture gets even slightly clearer or more into focus. So adjusted shareholders' net income came in at 1.51 billion. That's up 77% year over year. But when we go back, significantly less than 135% headline unadjusted shareholders' net income. And then also sequentially, quarter over quarter, that number only grew by 1%. So now you understand that, okay, the share price actually was stagnating because Xiaomi's earnings progress stagnated. And we also understand now why that was, because expenses increased so significantly. And only low quality items, a lot of which are adjusted out when you move to adjusted shareholders' net income, did conceal the significant increase in OPEX when you just look at the unadjusted numbers. But when you go through this adjustment analysis, you see the net effect. And the net effect is that a lot of the growth that we saw in the second quarter in the business was offset by expansion of expenditures. And that is currently the story and why the stock is stuck. That's the end of the first part of my video that I make available to everyone. For the second part of my video, where we discuss valuation, attractive entry or exit points into the stock, and how I plan on taking advantage of this opportunity, I will only share with my subscribers on X. So if you haven't subscribed already, I highly recommend you go to X, search for my account Alojo, and click the subscribe button where you can, for a very small monthly fee, get access to a large amount of quantitative financial research, but also a number of deep dive videos like the one you just watched, plus valuation and trading discussion on a large number of companies like Tesla, Nvidia, Palantir, Rivian, Lucid, Microsoft, Meta, Amazon, Alphabet, aka Google, Ford, General Motors, and a number of other companies. Thank you very much for listening. See you next one. Bye.